as we look at cable trading at 126.68 right now, how clear is the path to 120 and below? That would be a 2016 low.
Good morning, Naira. Discussions around the sterling and the whole situation of seeing the end of May before May has already seen the market selling off in advance. So the market is bracing right now for a successor that will take a much harder stance on Brexit, like Boris Johnson. And I think right now we're stabilizing here, and we will be waiting for the European Parliament elections, which of course both sides of the equation will use as a vindication to kind of prove their point. We would just highlight that this of course is not yet a referendum, and but I would expect some volatility on the back of it. Is this a 120 direction? I don't think so.
Yeah, Stefanie, you say that the market is bracing for a harder Brexit and possibly for Boris Johnson as the next leader. I would counter that actually the market is still underpricing that risk, particularly if you look at risk reversals, for example, on the pound. They don't seem to be braced for a no-deal Brexit. So is there a lot further downside to the pound from here? Where would you target in the next 3 months?
Yeah. The problem is that actually both probabilities have gone up. No deal and no Brexit. So I think that is where the market is stuck in between, and this is where you rightly point out you're not seeing that the whole market is just shifting and bracing for a hard Brexit. In the next 3 months, and also for a longer term horizon, we actually see a continuation of what we have seen happening in the past, the sterling being in a wider range without any resolution being in place, which is a binary event, actually not breaking out to either side to the extreme, as you were suggesting before.
Makes sense. Stefanie,
so
in terms of some... 128, go ahead.
No, I was just saying, so 128, 130 handle or around that level, I think it's more realistic than to claim something extreme on the outside, like a 120 or 135 or 140.
All right, makes sense. Now, let's just turn to sort of the risk situation broadly, Stefanie, because yesterday we saw US equities sell off, the S&P 500 dropping more than 1%. That seemed to be largely fueled by that US manufacturing PMI coming in soft. Also, of course, you've got the trade war concerns. 10-year yield hit a 2017 low. Interestingly, the dollar didn't actually rally, so it didn't seem like that was the chosen safe haven yesterday. You're preferring to actually look at currencies that are neutral risk rather than risk on, risk off. Why? Well,
first of all, before you conclude too early, actually, that the dollar is not a safe haven currency, I would concur that is actually not the truth. What we've seen yesterday is that we had a very strong technical reaction in euro dollar. We had almost a textbook-like test of the 111.10 support area, and we've been eyeing and working towards this for the last few trading sessions already. And there was almost an expectation once we tested there will be a strong bounce to see whether this breaks on the first attempt or not. Well, you know, the currency market typically, if there's very strong support levels, it doesn't go there or go beyond and through this without any bigger headline on the first go. So to see the counter reaction and go back to a 111.85 handle where we are now, it doesn't put the dollar as a safe haven in question at all. Again, we are trading under a very important technical level, which is 111.90, and as long as we are here, the downtrend that we still have in place in euro dollar in the 2018-2019 time frame is still fully intact. So, but nevertheless, there is of course a benefit of looking to currencies that are not trading on a risk-on, risk-off handle, especially as we are now entering into this headline-driven risk-on, risk-off US trade, etc. Environment. So picking the currencies that are very low, expose a very low correlation to S&P returns actually can diversify the portfolio quite a lot. So I think something like Euro Canada, Euro Kiwi is interesting to look at.